Seeing this wave of risk aversion gripping markets, and this was a reaction that we saw even despite initially those reports being unverified. It's clearly a case of investors selling first and then asking questions later, traders not quite prepared for this sudden revival of Middle East tensions. And to be clear, we already saw markets mostly in the red, and this was on the backdrop of those Fed speakers coming in hawkish. We also heard from the likes of TSMC, for example, lowering its outlook for the chip sector. So the chips were really already badly hit, and then as the Nikkei opened 1% lower, it really sank. Those losses accelerated as those reports about these explosions in Iran, Iraq, Syria started trickling in. Now we're also seeing the MSCI Asia Pacific, a gauge of stocks in the region, hovering at the lowest level since early February. Now we're seeing Brent, US crude futures, they're both rising almost $3 a barrel, above the $90 handle. And we're also watching out for the implied volatility. Take a look at this chart if we can, and it'll show you that implied volatility on crude is surging. So this suggests that we could see even more days like this, swings in the price action. And this makes you wonder exactly what this is going to mean for people that are watching the inflation front. Now, I want to take you to what we're seeing on the safe havens as well. The usual suspects are moving. We're seeing it on the dollar, yen, Swiss franc, gold, treasuries as well. Worth highlighting here, we're seeing the yen moving below the 154 level against the greenback. The Swiss franc, it jumped as much as 1.2% against the US dollar earlier on in the session. And this is worth noting because the Swiss franc has been capped recently due to dollar strength. So the moves today indicate how the Middle East tensions are perhaps a bigger mover compared to the Fed bets.